All right, good afternoon, everyone. It is great to be here as always. It's always tricky presenting towards the end of the day, so I'm glad to see that when faced with the decision to sit in traffic or listen to me, you decided to listen to me. But then again, Joburg traffic lately has been horrendous, so I guess many people would rather have a colonoscopy than sit in Joburg traffic, so the bar isn't set exactly high for me this afternoon. So when you look at today's title of the presentation, you might have two thoughts. First, A, get me the hell out of here because this sounds very doom and gloom, or B, AJ must be the oracle because the title for these presentations had to be submitted 2 months ago, so how the hell did he know about the world is ending and Iran's war? Well, the fact is that it's neither of those. Today's presentation is about the fact that the landscape that us as investors have gotten used to over the last 30-odd years has fundamentally changed. And the map that we've been using to navigate this landscape is utterly useless. It's broken. But the new landscape and the new terrain is filled with exciting opportunities if you know where to look. And today I would like to take you through and show and tell you how we as Peregrine Capital navigate this new changing landscape and environment and where we see opportunity in this landscape. Well, before we get there, I want to take a brief detour to the island of Naxos in Greece. Now, my wife and I have been privileged enough to visit Greece about 3 years ago, and we spent some time on Naxos. And on Naxos is the mountain called Mount Zas, as the Greeks refer to it, or the mountain of Zeus. It's the highest point in the Greek Cyclades, that area of Greece. And that's actually a real picture of me hiking Mount Zas. And my wife and I, we're quite adventurous, or we like to think we are, and we like the outdoors. So we decided we were going to hike Mount Zas. Now, like a typical man, confident in his own abilities, like myself, I never look at the instruction manual for a piece of assemble-at-home furniture, for instance. I also just had a brief glance at a TripAdvisor blog, had a quick look at the map online. I told my wife, it's easy, let's just do it, let's go. So the next morning we sat off, drove, took a leisurely stroll around some of the villages, drove through the island at breakfast, and we stopped next to the road where we could see the mountain and make a bit of the trail out in the distance. And we set off on a hike, and immediately when we started, I realized that this was a big mistake because this is going to be a way more strenuous hike than I actually anticipated. But I didn't tell my wife because I knew she would make us turn around if she found out. And luckily, when she eventually found out, it was way too late to actually turn around. So we did make it up to the mountain in the end, but it was more than 2 hours, and we were drained. We weren't equipped for this hike, but we made it to the top. And at the top, we took some pictures, we spent some time, took in the scenery, and we savored the one apple we had between the two of us. And as we gathered our things, I realized that we were alone at the summit. Everyone else had left. And when I started to look around, it struck me that the terrain in every single direction looked exactly the same as in this picture. There were just rocks everywhere and a few scrubs and bushes here and there, and you couldn't even see the trail. The trail stopped a couple of 100 meters before the summit because of the way the terrain looks like. And again, full of confidence, I told my wife, it's this way. And, well, spoiler alert, it wasn't that way. So we ended up descending on the wrong side of the mountain. We were supposed to descend on the west side. We ended up descending on the east side. And by the time we realized it, we also realized that we were utterly and hopelessly lost. And it was like a perfectly scripted Hollywood movie because as that realization set in, you could hear the thunder, you could see the dark clouds gathering, you could feel the wind pick up. And I kid you not, it truly happened. And the whole day, the clouds were sort of lingering on the horizon, but at that point, a storm was gathering. And I knew that the last place you want to be when there's a storm is on top of a mountain all exposed. So I told my wife, strap in, we're going to have to gun it and run across the ridge of the mountain from the east side to the west side. So we ran through bushes, over thickets, over rocks. We got scraped and bruised. My wife still till this day believes she almost stepped on a snake. And at the end of the day, we did make it down the mountain, obviously. It was quite a dramatic, even a traumatic experience, but we made it down the mountain. And the lesson of this whole thing, this whole journey is quite simple, is that the map is not the terrain. Knowing what the map looks like does not prepare you for what the actual terrain looks like. And when the terrain changes, relying on this map is not just useless, it's dangerous because it can lead you down a path where you don't want to go. And this whole experience and story made me think about today's market environment and that investors today experience, because we believe that the map that we've used to navigate the investment landscape of the last 30 years is fundamentally broken. And from where we are standing, investors need to lift their gaze up from this map, look at the environment around them, and navigate based on this environment. Now, the map that we've been using worked very well, and in fact, it worked so well that investors forgot to look at the terrain around them. Now, let me just briefly touch on what this map actually looked like. Since the fall of the Berlin Wall and the end of the Soviet Union, or the Cold War for that matter, the world has been a pretty peaceful place. There's been some regional conflicts and wars, but there hasn't been a major world war, a major worldwide conflict. And over the last 30-odd years, the US definitely rose as the dominant power. US hegemony was at the order of the day. The US led and drove globalization, which drove down interest rates and inflation. Cash was king, bonds was safe, the dollar was the undisputed reserve currency of the world. You could put together a 60-40 balanced portfolio, close your eyes, and things would be fine. Central banks would bail you out. Everything just sort of worked. There was no need for safe haven assets or store of value assets for that matter. Everything just worked. Well, it worked until it didn't. Now the question is, what went wrong? And the answer is everything, and in a very short space of time. Over the last 10 years or so, China rose up as the dominant superpower, or as a dominant superpower challenging the US supremacy. And I think in the last 2 to 3 years, the map just tore apart and completely broke, and the dominoes started to fall quickly upon each other. The US decided to weaponize trade and slap tariffs on every country out there. They pulled out of major world organizations. They are taking presidents from their beds at night, talking about claiming sovereign land, starting a war in Iran. We've seen France saying they're going to beef up their nuclear arsenal and stop disclosing the number of nuclear weapons that they have. Poland is saying they want to start their own nuclear program. The point is that trust broke down and walls have gone up, and the world have realized that they can no longer rely on the US to be a reliable partner. On top of this, most central banks, especially the Fed or the US as a government, has racked up massive amounts of debt, running a massive fiscal deficits. And one way of getting out of this is to simply just print more money, print more dollars, which devalues the value of the dollar. And lastly, another shot across the bow happened when Russia invaded Ukraine, and the West decided, well, we'll just sanction and take your foreign reserves held in US dollar. Thank you very much. Now, if you any other country out there, would you really risk putting your faith, trust in your assets in another country's currency if that country, if you just so happen to be in a conflict with them, could turn around and say, thank you, we'll just take your assets? I think not. So the map that we've been using is broken. Well, the question is, now what? And as I've said, we believe that you need to look up from this map and look at the environment around you and look for things that will hold value in this new world order. And the first answer to what will hold value in this new world order, we believe, is actually the oldest answer in the book. And we refer to it as our store of value thesis, or our store of value trade. We believe in this new world order, things that are physical but also physically scarce, things that you can't just replicate or create more of or sanction, are things that will hold value. And these include things like gold, silver, PGMs, platinum, palladium. You can even throw Bitcoin in there. There will only ever be 21 million Bitcoins in existence. High-quality equities, companies with deep, impenetrable moats that you can't just simply compete with, and even property. I'll not be quick to throw Joburg property in there just yet, but property as an asset class as a whole, you can also put in this basket. And the market tends to agree tends to agree with us. This chart shows the cumulative inflows into gold ETFs over the last 2 years. And in 2024, there was a total of $5 billion that flown into gold ETFs. And this increased to $89 billion in 2025. Now, this isn't just a trend. This is an utter stampede. And this dragged along metal prices with it, with gold and platinum being up more than 130%, silver being up more than 300%. And this isn't just speculative retail buying. This is the biggest institutions in the world, and most importantly, central banks saying that we realize we can no longer put our faith and trust in something like the US dollar as a reserve currency, and we need to look for things that are physically scarce, like gold, for example. Now, the second thing which we see value in is artificial intelligence, and I know it might sound hyperbolic, but we truly believe that AI is the most profound change in human history. One of the issues of AI, unfortunately, is that many people have this sort of perception of AI, in the sense that us people and humans, we think that we are superior. We sit up here, we're the most intelligent beings ever, and we look down at AI, and AI is almost this sort of cute robot that can do monkey tricks. It's a ChatGPT that can summarize a document or give you a recipe if you ask it. But this underscores a fundamental issue of human bias, and that humans automatically assume that progress is linear. That just because it took so long for AI to progress to this level, or because it took so long for the Industrial Revolution and all the innovations that came with it to play out, therefore it should take so long for AI to get to our level of intelligence. But the reality is actually 180 degrees removed from this. The reality is one of exponential growth because technological progress compounds on itself. And we are now at that stage where AI becomes self-reinforcing. It's teaching itself, learning from itself, and improving itself. And we are actually entering the era of the vertical or the exponential, where AI is going to exceed and surpass human intelligence. And many people haven't updated their mental model for this yet. Many people still think that AI is going to slowly take the stairs to our level of intelligence. But instead, it's going to take the elevator straight past us into the realms of artificial superintelligence. Now, it's a lot of big words, artificial superintelligence and exponential. So let's just unpack that for a moment before we move on, right? So Jensen Huang, the CEO of NVIDIA, he said 2 weeks ago that over the last 3 to 4 months, something has fundamentally shifted in the world of AI in the sense that AI has become agentic. What he meant with that is that you can give AI a task and you can leave it completely autonomously by itself and it can do the work all by itself. And this is going to create real economic value and massive increase in productivity. Now this chart is, there are 2 charts on here. You separate into 2 parts. The one on the left, your left, is a theoretical argument. And it basically says that for all of humanity's existence, human beings have been the most intelligent species on Earth, right? That's a fact. But that is no longer true. We are entering the era where we're going to cross what experts call the tripwire. And as I just said, AI is becoming self-reinforcing. It's teaching itself, learning from itself, and improving from itself, and therefore going to become much more intelligent than us human beings. And the chart on the right is a practical demonstration, an example of this. The chart on the right shows the amount of time that you can leave an AI agent completely autonomously by itself to conduct an intellectual, human-level task without interfering with it, and how that has progressed over the last couple of years. And as you can see, a couple of years ago, you could barely leave an AI alone without interfering and prompting it constantly, but just in the space of 2 weeks, we've gone from 5 hours to 15 hours, and this is what exponential growth looks like. Now, you might say, okay, cool, this is nice, it's theoretical. What does it practically mean and look like for you and I today? AI is already so much more than you and I can think. And for most people, unfortunately, AI is still confined to a chatbot, asking for a recipe or summarizing a document. But that's sort of like saying the internet is email. That just completely misses the point. And for us, one of the most profound breakthroughs in innovations in AI is in the field of programming or software development, where we've seen AI being able to program way better than even the best human programmers out there. And it's not our opinion. It is these best programmers out there who's admitting and saying that AI can do their work better than themselves. And AI has become agentic, meaning that you can give AI a task, and it can create software from end to end all autonomously by itself. And another thing that we've observed is what they call vibe coding, where anyone and everyone with zero technical or coding ability and experience can, in plain English, tell the AI what it wants, and it can spin up software from start to finish, all with a mere text prompt. We've seen the rise of humanoid robots. This video is from the Chinese New Year celebration, just to give you an example of what these robots are capable of. And these robots will work in our factories, they will work in our homes, they will tend to the elderly, they will do jobs that many blue-collar workers today are doing, they will do in the future. We've seen the rise of autonomous vehicles. It's vehicles like Waymo in the US that's going to do more than 15 million trips this year as a ride-hailing service, that is driving completely autonomously by themselves with no human interaction and intervention whatsoever. Deliveries being done by drones. Augmented reality glasses like Meta Smart Ray-Ban glasses that will be equipped with AI that will assist people in their everyday lives as they go about. We are able to create cinema-level, Hollywood-level, or quality-level movies with mere text prompts. You can prompt an AI and it create the script, the narrative, the scenes, the visualizations, everything from scratch with a mere text prompt. The innovation is just mind-blowing and staggering. Now, you might tell me, okay, cool, this is nice, but this sounds a bit outlandish and too futuristic. Fine, I get that. But let's listen to what some of the people at the forefront of AI development are saying. So Dario Amodei is the CEO and the founder of Anthropic, one of the frontier AI labs. He's recently in an interview last month said that Anthropic has gone from 100 million to $1 billion to $10 billion of revenue in the space of 2 years. That is a 10x upon a 10x increase in the space of 2 years. And actually, last week, they announced that they are actually at a 20 billion annual revenue run rate for this year. And he also said that more than 90% of all the code at Anthropic is currently being written by AI, and we can corroborate this. Many companies that we speak to say that the majority of their code is being written by AI already. He also said that he thinks we're going to enter an era of artificial general intelligence, or AGI, in the next 2 years, meaning that AI will be able to conduct any intellectual or intelligent task that us human beings can. It can think abstractly, it can reason, it can solve problems. And all of this will lead to trillions of dollars in AI-generated revenue in the next 5 to 8 years, because we will have essentially, if you think about it, countries filled with geniuses. We will have data centers equipped with thousands and millions of GPUs, which will act like countries filled with geniuses. And all of this will lead to tremendous economic growth. Now, I know 10 to 20% sounds outlandish, but let's just humor it for a second, because the amount of productivity and the amount of output that we will have as a consequence of AI will be tremendous, and it will certainly lead to much faster economic growth. Cool. You might tell me, okay, well, this is one guy talking his book, he's biased, he's investors in this space. Fair, I take that. I'm going to counter you and give you 700 billion reasons why this is not just one guy talking his book. This chart shows you the cumulative capital investment, or CapEx, that the big hyperscalers, the Facebooks, the Metas, the Googles, and the likes, are investing and spending in AI. And this year, they are set to spend more than $700 billion on AI. I mean, this is not airy-fairy, fluffy money. This is the biggest companies in the world putting their balance sheets on the line and spending every cent of free cash flow they generate on AI, building the data center, putting the cooling, electricity, the racks, servers, GPUs, everything that's needed to power AI into place. Now, the scary thing is that despite the biggest capital investment and outlay in human history, all these companies are saying that they're capacity constrained. They simply can't keep up with the sheer demand for AI. And conceptually, if you think about it, at least in my opinion, I think we are less than 1% penetrated in terms of people who actually use AI to its fullest, and also in terms of use cases, less than 1% penetrated. So I think that the growth and the runway for growth is just tremendous. Now, because of all this money being funneled into AI, you and I, and society as a whole, is benefiting, because AI is not only becoming more powerful, but it's also becoming cheaper to use. This chart shows you, going back to the first instance of ChatGPT in 2022, that in 2022, if you look at the bar, ChatGPT could process around 4,000 tokens. Think of it as processing 4,000 words. It costs around $20 to process those 4,000 tokens, and it could barely pass the bar exam. That's the US, exam to become an attorney and practice law. Fast forward to today, the latest version of ChatGPT was launched last week. It could process 1 million tokens, and it's costing $2.50 to process that, and it has PhD level of intelligence. Now, that is a 250-fold increase in the capacity of these models, this model specifically, at almost a 90% reduction in cost. And this is what is enabling all that I've just shown you before, all the use cases, the vibe coding, the humanoid robots, everything that we're seeing in coding, the autonomous deliveries or driving and drone deliveries. All of this is being made possible because AI is becoming more powerful and cheaper at the same time. Now, where do we see opportunity in AI? We, in fact, see opportunity across the value chain and across the stack. From the very top layer, the guys who are creating the software applications embedded with AI that you and I will use, to the middle layer, the guys who will be hosting these software providers on their cloud service platforms. But the most profound value we see being created at the moment is in the basic foundation infrastructure layer. These are the guys who are laying the railway track, so to speak, upon which all these other companies will move and will build in the future. These are the semiconductor companies, the companies who are designing and supplying each and every component that goes into a data center and putting the chips and the GPUs that goes into a data center together. Now, when we looked at it, we say, okay, cool, there's more than $700 billion, of which the majority of that is being channeled into this specific sector. Where's there a bottleneck and a choke point? Because most often, capital flows follow a bottleneck and a choke point. And if we all agree that NVIDIA is the most valuable company in the world, what is the one company that NVIDIA cannot exist without? And the answer is TSMC, Taiwan Semiconductor Manufacturing Company. And I know there's a risk that I might sound very dramatic and hyperbolic here, but I truly believe that TSMC is probably the most important company in the entire world. TSMC is the only manufacturer of leading-edge chips. Every single chip that goes into a data center, in fact, every single chip that goes into a leading-edge device, like your iPhone and your iPad, is only and can only be manufactured by TSMC. And TSMC is, in fact, a very narrow gate which through each and every company has to pass through. A toll, if you want, on AI. And we believe TSMC is incredibly competitively advantaged and will grow 30-35% plus for the next 5 to 8 years. And all of this scarcity actually has a location because TSMC and the whole ecosystem is based in Taiwan. Now, just as technological scarcity has a location being in Taiwan, physical scarcity also has a location. The physical scarcity that I've just spoken to in the previous point about store of value assets. This physical scarcity's location is in South Africa. Now, the treasure has always been on the map. It's just sort of that the market and the world forgot where to look. And we believe that SA currently has the wind in its sails because of the store of value trade and the store of value thesis that I've outlined in the previous point. 88% of all PGM reserves sit within South African soil, and SA is one of the biggest gold producers out there. Now, because of the store of value trade and the increase in the metal prices, we've seen our trade surplus balloon because we export more than we import, and because of that, all these miners getting paid in dollars have to convert that, bring it back to rand, so there's demand for rand. The rand gets stronger. Because of that, inflation gets lower. That gives the SARB scope to cut interest rates, and all of this combined alleviates and reduces stress from the consumer and means the consumer has more money in their pocket to spend. Now, I'll get to the elephant in the room, don't worry. This chart will look incredibly outdated come next month, but this chart shows you how much the diesel and the petrol price and interest rates have declined over the next 2 years. And because of all of this and the tailwinds that SA has, we believe it's prudent to allocate capital to companies facing consumers in SA, companies like banks, like food producers, and like retailers. Now, I'm not ignorant, and I know what's happening out there in the world, so that's why I've prepared for that. I think the caveat to this is that if this war and the situation in Iran carries on for longer than expected, longer than a few weeks, oil prices will remain higher, and that will mean inflation will remain higher, and then that means obviously more pressure on consumers and less likelihood of interest rates coming lower. But true to the title of my presentation, we've read the landscape and the environment, and we chose to adjust and adapt. And we bought call options on oil and Brent crude, which we hope and believe that will act as a hedge against such an event that higher oil prices will translate to inflation and to pressure on the consumer. But even if the war ends up being a prolonged war, there is a scenario where I actually think this works out well and positively for SA. Because if the war drags on, the US is going to have to spend hundreds of billions of dollars to fund this war. How are they going to fund it with the data they currently have? Well, they're going to print more money. If they print more money, it's going to be good for the gold price. If it's good for the gold price, it's good for SA, it's good for the rand, it's hopefully good for inflation, and hopefully that shields us from the turmoil out there, even if the war drags on for longer. Now, that's the terrain. It's physical assets, it's AI, and it's recovery in SA. But knowing what the terrain looks like and actually navigating it are two completely different things. So I would like to switch gears and shift from how we are viewing the terrain to how investors are experiencing this terrain. Because even though your end destination might be right, the journey and the way in getting there might still break you. Now, speaking of journey, I think there's a lot of uncertainty around the moment. Suffice to say, it's obvious. The uncertainty that's front of mind is obviously what is happening in Iran and how that will affect the whole world, but I think a bigger overarching uncertainty that will linger for a longer period of time is how AI will affect society as a whole and the economies around the world. And I think it's not a matter of if, but when AI will lead to mass white-collar job losses. And then the question is, what will the implication of that be? Will there be large household defaults? Will there be, will that lead to, because of the job losses, governments having to print more money to fund a universal basic income to pay all these people that have lost their jobs? What will that mean for government deficits? What will that mean for government defaults as a whole? There's a lot of uncertainty around. The journey ahead is certainly not going to be easy, and there's uncertainty around what the journey will look like. Now, speaking of journey, when my wife and I stood at the top of Mount Zas and we looked down around us, we didn't know which direction to go, and we descended down the wrong side of the mountain into a storm. But we did make it down the mountain at the end of the day. But the journey could have broken us. And the same goes for many investors. Many investors might have turned around halfway, went back up the mountain, or sold at the bottom. Many investors don't fail because they have the wrong long-term destination. They fail because the journey simply gets too tough. The volatility gets too much, the drawdown gets too steep, the headlines get too scary, very much like we're seeing this week, right? They panic and they sell at the bottom. And that's not a theoretical behavioral risk. It's very real. It happens. So yes, the end destination is important, but I'd argue the journey and the way in which you get there is actually even more important. And I'd like to propose that hedge funds have the right tools at our disposal to smooth this journey for investors. Now, how do we do this? Well, we do this by using various tools at our disposal, such as short selling, pair trading, and the use of derivatives. And this is a practical demonstration of how we as Peregrine Capital have used these tools to smooth the journey for investors over the last 27 years. This chart shows you in the red bar every single month that the JSE as a whole was down for that month. And on average, when the market was down for a month, it was down by around 3%. And in contrast, the yellow bars shows what our funds have done in that very same month when the market was down 3%. And our funds, in contrast, were up 0.5% on average. Now, this clearly shows and demonstrates that the tools that we have, but I think most importantly, the way in which we use them, work when it matters the most and smooths the journey for investors. Now, why is it important to use these tools? A, to smooth the journey for investors, as I've just shown you, but B, it significantly improves the end result and the end outcome for investors. I think many of us would know this chart. This chart shows what your return would have been if you missed the 10 base days in the market in the yellow line, and then what your return would have been if you just stayed fully invested. And we all know this lesson of it's not about timing the market, but it's about time in the market, right? Well, what if I told you if you missed the 10 worst days in the market, you would have been significantly better off. 54 times your money compared to 26 times your money had you stayed fully invested. Now, the lesson here again is simple, that the power of protection, protecting investors against drawdowns and volatility, not only smooths the journey, but it, at the same time, leads to a significantly better outcome. With that, I would like to bring things to a close. As my wife and I stood at the top of Mount Zas, as I said, the terrain looked indistinguishable in every single direction. We chose the wrong direction. We descended down the mountain into a storm. It was a dramatic experience, but we did make it down the mountain at the end of the day. But we didn't make it down the mountain because we miraculously had a new map to navigate. We actually made it down because we lost and forgot about the map, and we looked up and we looked at the terrain around us and navigated based on what that terrain looks like. Now, the terrain that we are used to as investors and the map that we've used to navigate the terrain is utterly broken. The world as we know it, the world of US hegemony, of the dollar being the king, that world is over. It's done with. But here's the thing. It's just the world as we knew it, right? The new world, the new landscape is filled with exciting opportunities. And those opportunities are there and they're real. But the terrain doesn't reward autopilot. It rewards the navigators, the guys with the tools in their hands. And I firmly believe that hedge funds and us at Peregrine Capital specifically have the right tools to smooth the journey for investors. And at Peregrine Capital, our sole and only focus is on performance. And we will continue to forge ahead and keep our gaze firmly fixed on this one single goal, and at the same time use all the tools at our disposal to generate superior risk-adjusted returns regardless of what the terrain looks like. That is my story. Thank you for listening.